Silver has just shattered the ceiling, hitting a record high of $50 per ounce and effectively doubling in value over the course of 2025. Yet the data indicates this is merely the ignition point for a much larger move toward $100 in the coming year. This isn't speculative hype or wishful thinking. It is the inevitable mathematical result of a 6-year structural supply deficit colliding with an explosion in industrial demand that the world is completely unprepared to meet. Before we dissect the forensic evidence of this market shift, if you want to stay ahead of the curve as we track this historic move to triple digits, make sure to engage with this content right now by hitting the like button and subscribing, because the window to act on this information is closing faster than the physical inventory in London vaults. The silence surrounding this rally is deafening, primarily because the mainstream financial media is fixated on digital assets and tech stocks, completely missing the tectonic shift occurring in the physical world, where silver has quietly outperformed almost every other asset class. To understand why $100 is not just possible, but probable, we must first strip away the noise and look at the raw supply and demand mechanics that have been broken for years. We are currently witnessing a phenomenon that has not occurred in modern history, which is a persistent structural deficit where the world consumes significantly more silver than it can extract from the Earth's crust. This is not a temporary anomaly caused by a mine strike or a logistical hiccup. It is a chronic condition that has been deepening since 2019, culminating in a projected deficit of 117.6 million ounces for 2025 alone. When you look at the geological reality, silver is rarely found in pure deposits anymore, meaning that the vast majority of supply comes as a byproduct of mining for other base metals like copper, lead, and zinc. This creates a dangerous inelasticity in the supply chain because even if the price of silver doubles or triples, miners cannot simply turn a dial to increase production. Their output is dictated by the demand for those other metals, not silver itself. This geological constraint is colliding head-on with the exhaustion of above-ground stockpiles, which have served as a buffer for the past decade but are now critically depleted. We are seeing inventories at the Shanghai Futures Exchange and the COMEX plummet to decade lows, signaling that the paper silver market, where billions of ounces are traded as digital contracts, is finally being forced to reconcile with the physical reality that the metal just isn't there. The mechanism that kept prices suppressed for so long was the ability of bullion banks to lease and sell silver they didn't have. But that game ends when industrial buyers like solar panel manufacturers and electronics giants demand physical delivery to keep their factories running. This brings us to the industrial side of the equation, which is undergoing a revolution that is fundamentally altering the demand profile of silver forever. Solar energy is no longer a niche green initiative. It is the fastest-growing source of electricity generation on the planet, and silver is the non-negotiable lifeblood of this industry due to its unmatched electrical conductivity. While engineers have tried to thrift silver, using less of it per panel, the transition to more efficient N-type and TOPCon solar cells actually requires more silver paste per unit, not less, effectively neutralizing any efficiency gains. This means that as the world races toward net zero targets and governments mandate renewable energy adoption, they are inadvertently writing a blank check for silver demand that the mining industry cannot cash. We are projecting that the solar industry alone will soon consume 20% or more of the entire annual global mine supply. A staggering figure for a single industrial application. Furthermore, this industrial demand is incredibly sticky, meaning that a solar manufacturer cannot simply stop buying silver because the price goes to $75 or $100. The cost of silver is a small fraction of the total panel cost, but without it, the panel does not work, so they will pay whatever price the market dictates to keep production lines moving. This inelastic demand from industry provides a floor for the silver price that did not exist during the speculative bubbles of 1980 or 2011. Beyond the solar sector, the electrification of the automotive industry is adding another layer of pressure, as electric vehicles require up to twice as much silver as internal combustion engines for their battery management systems and extensive electronic contacts. As the global fleet transitions to electric, we are locking in a secondary source of escalating demand that correlates directly with global GDP and technological advancement. However, the case for $100 silver is not built on industrial demand alone. It is amplified by the monetary role of silver, which is reawakening after decades of dormancy. We are living in an era of unprecedented fiat currency debasement, where central banks have printed trillions of dollars, euros, and yen, systematically eroding the purchasing power of paper money and forcing capital to flee toward hard assets. Historically, the gold-to-silver ratio, the number of silver ounces needed to buy 1 ounce of gold, has averaged around 50 to 1, and in geological terms, the ratio of occurrence in the Earth's crust is closer to 15 to 1. Currently, with the ratio sitting near 73 to 1, silver is mathematically undervalued relative to gold, implying that even if gold stays flat, silver would need to rise significantly just to revert to its historical mean. But gold is not staying flat. It is breaking out to new highs as central banks, particularly in the East, aggressively accumulate bullion to diversify away from the US dollar and sanction risks. As gold pushes higher, it drags the entire precious metals complex with it. But silver, being the smaller and more volatile market, acts like a slingshot, typically outperforming gold by a factor of 2 or 3 during the aggressive phases of a bull market. The psychology of the market is also shifting as retail and institutional investors begin to realize that the safe haven of government bonds is no longer safe in a high inflation, high debt environment. When this realization fully hits the mainstream, the amount of capital that will rotate into the precious metals sector is so large relative to the tiny size of the silver market that it will be like trying to push the water from the Hoover Dam through a garden hose. The total available investment-grade silver on the planet is valued at a fraction of the market cap of a single large tech company, meaning that even a 0.5% allocation from global pension funds or hedge funds would overwhelm available supply and send prices vertical. This liquidity squeeze is what causes the violent upside moves characteristic of silver, where the price can move $5 or $10 in a single trading session once the momentum takes hold. we must also consider the geopolitical dimension, where the breakdown of global supply chains and the rise of resource nationalism are prompting countries to classify silver as a critical strategic mineral. If a major producing nation were to restrict exports to protect its domestic solar industry or to build strategic reserves, the global deficit would instantly transform from a problem into a crisis. This scenario is not far-fetched, as we have already seen similar moves in other battery metals like nickel and lithium, and silver's dual role as a monetary metal and an industrial component makes it a prime candidate for strategic hoarding. The smart money is already positioning for this, which is why we are seeing premiums on physical coins and bars remain elevated even as the spot price rises. A clear indication that the physical market is tight and decoupled from the paper price. Analyzing the technical landscape, the breakout above $50 was the critical psychological and structural barrier that had capped the market for over 4 decades, dating back to the Hunt Brothers era of 1980. Now that this ceiling has been shattered, there is no overhead resistance on the charts, meaning the price enters a mode of price discovery, where it seeks a new equilibrium that balances the extreme supply-demand imbalance. In this vacuum of resistance, technical targets quickly extend to the inflation-adjusted highs, which, depending on how you calculate inflation, would put silver well above $150 in today's purchasing power. The move to $100 is therefore not an arbitrary target, but a conservative milestone on the way to repricing silver in a world where the currency supply has expanded exponentially while the silver supply has remained stagnant. It is crucial, however, to approach this market with a strategy rather than blind exuberance, understanding that silver is notorious for its volatility and its ability to shake out weak hands before the real move occurs. The smartest way to play this is to build a core position in physical metal. Sovereign coins like American Eagles or Canadian Maples, which eliminates counterparty risk and ensures you actually own the asset you are paying for. For those seeking more liquidity or leverage, the strategy shifts toward trusted ETFs like the Sprott Physical Silver Trust, which differs from others by holding fully allocated metal that is not leased out or encumbered. This distinction is vital because in a true financial crisis or a short squeeze, unallocated paper contracts may be settled in cash rather than metal, defeating the entire purpose of holding silver as insurance. The mining stocks offer the highest potential returns, acting as a leveraged bet on the metal price, since a 50% rise in silver can often translate to a 200% or 300% increase in a miner's free cash flow. However, this sector requires careful due diligence to avoid companies with poor management, jurisdictional risks in unstable countries, or operational challenges that could dilute shareholder value even in a rising silver price environment. The timeline for this move to $100 appears to be accelerating, with the supply crunch likely to become headline news in the second half of 2026 as industrial users begin to panic buy to secure inventory. We expect to see a classic fear of missing out or FOMO phase where the general public rushes into the market, driving premiums higher and creating a feedback loop that pushes the spot price to levels that seem unimaginable today. Yet, even at $100, silver would still be cheap relative to other assets like real estate or the S&P 500 when priced in gold or historical norms, suggesting that the triple-digit barrier is merely a psychological checkpoint rather than a final destination. The wealth transfer that occurs during these commodity supercycles is massive, moving purchasing power from those who hold paper assets to those who hold real, tangible resources. The risks, of course, remain, primarily in the form of a deflationary liquidity event where all asset prices sell off together in a panic, similar to March 2020. However, history has shown that while silver may dip initially in such a scenario, it rebounds the fastest and the hardest as central banks respond with liquidity injections, which is exactly the rocket fuel that powers precious metals bull markets. Therefore, the pullback, if we even get one, should be viewed not as a reason to panic, but as a final opportunity to accumulate ounces before the market moves out of reach for the average investor. The window of opportunity is defined by the availability of physical metal, and once the retail shelves are empty and the wholesale delays stretch into months, the price on the screen becomes irrelevant because you simply cannot buy the metal. We are watching the end of an era of price suppression and the beginning of a new paradigm where the laws of supply and demand finally assert their dominance over the derivatives market. The convergence of green energy mandates, monetary debasement, and geological scarcity has created a perfect storm for silver that happens perhaps once in a generation. As we navigate this volatile path to $100 and beyond, discipline and conviction will be your most valuable assets, allowing you to hold through the noise and capture the immense value that is being unlocked. This is not just a trade, it is a recognition that the financial system is changing, and silver is reclaiming its rightful place as both an essential industrial material and a form of honest money. If you found this analysis logical and helpful in navigating the chaotic markets, please make sure to subscribe and leave a comment below with your own price targets and strategies so we can continue to uncover the truth about the economy together.